Want market returns without emotional mistakes? Start by thinking like an investor. Prioritize expected return per unit of risk, time horizon, liquidity needs, and opportunity cost. Professional investors use frameworks like discounted cash flow, diversification, and probability-weighted scenarios to estimate value. First, treat price and value as different things. Price is what you pay. Value is what you get, said Warren Buffett. Your job is to estimate intrinsic value, the present value of expected cash flows, and compare it to market price. Use DCF or sensible multiples, and always demand a margin of safety like Benjamin Graham taught. Second, quantify risk properly. Volatility is only one measure. Focus on downside risk and permanent loss of capital. Measure volatility with standard deviation and beta, but measure downside with maximum drawdown and stress scenarios. Professionals also target risk-adjusted returns, like Sharpe ratios, to compare ideas on an apples-to-apples basis. Third, set a clear time horizon. Short-term traders need liquidity and quick signals. Long-term investors prioritize fundamentals and compounding over years. Remember the 2008 crash. The S&P 500 fell roughly 57% peak to trough, so your horizon defines whether that's a temporary drawdown or permanent capital loss. Fourth, diversify intelligently. Modern portfolio theory shows the power of mean variance optimization and the efficient frontier, but diversification is more than mixing assets. It's combining uncorrelated return streams and limiting position sizes, so a single loss can't ruin the plan. A classic 60-40 equity bond allocation still guides many moderate-risk portfolios. Fifth, think probabilistically. Assign scenarios and weights instead of binary predictions. Price a base case, bull case, and bear case, then compute probability-weighted intrinsic value. That reduces overconfidence and keeps you grounded. Sixth, respect liquidity and opportunity cost. Holding cash has an implied return, the interest you forgo in other assets, and the option value of staying flexible during dislocations. Passive investing has attracted massive flows. Vanguard and BlackRock now dominate large swaths of market capital, but active managers must still justify fees with expected excess return net of costs. Seventh, use behavioral checks. Investors are biased. Loss aversion, overconfidence, and herd behavior distort decisions. Create rules to counter them. Predefine position sizes, stop-loss frameworks, rebalancing rules, and checklist-based due diligence. Eighth, combine qualitative and quantitative analysis. Fundamental investors study management quality and business economics. Quantitative investors rely on signals and backtests. Many top investors blend both approaches to generate ideas and manage risk. Ninth, monitor key metrics: earnings power, free cash flow, return on capital, leverage, margin of safety, and liquidity ratios. Institutional shops also watch portfolio-level metrics like portfolio drawdown, concentration, and Sharpe ratio. 10th, learn the history so you can avoid repeating mistakes. Value investing traces to Benjamin Graham and David Dodd and was crystallized in The Intelligent Investor in 1949. MPT and efficient frontier thinking emerged from Harry Markowitz in the 1950s. Bubbles and crises: 1999 tech bubble, 2008 financial crisis, 2020 COVID crash, reveal limits of models and the constant importance of risk management. Practical checklist to act: 1. Define your time horizon and liquidity needs. 2. Estimate intrinsic value with at least 2 methods. 3. Calculate downside scenarios and required margin of safety. 4. Size positions so no single trade can wreck your portfolio. 5. Ensure diversification across uncorrelated assets. And 6. Write a simple monitoring plan with rebalancing triggers. Quick examples. Compare a stock with a DCF-derived fair value of $100 trading at $60. Margin of safety exists if your assumptions are reasonable. Contrast that with a high-flying growth stock trading at 50x earnings. If revenue misses, downside is much larger. Remember the numbers. Balanced portfolios often use roughly 60% equities and 40% bonds. Long-term S&P returns average near 7 to 10% annually after inflation. Severe bear markets can cut 30% or more, and 2008 reached about 57%. Common misconceptions: higher volatility does not automatically equal higher expected return without compensation for permanent loss. Investing is not the same as trading. Famous lines to keep. The intelligent investor is a realist who sells to optimists and buys from pessimists. And Charlie Munger's warning that it's often better to buy a wonderful company at a fair price. Finally, build routines, weekly portfolio reviews, monthly rebalancing checks, and an annual deep dive on assumptions. Thinking like an investor is a disciplined process. Estimate intrinsic value, price risk properly, set horizon, diversify, and act when probability-weighted reward exceeds risk. Do that consistently, and you buy the edge that compounds.